Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello, and as always, I'm going to run through the most important charts and themes in markets and investing. We have to start out with what has become the AI mania. This has been building for some time. During earnings season, we've been talking about just the mentions of AI going up significantly. If you look at Alphabet, Meta, Microsoft, Amazon, and Apple, 190 mentions of the word AI in their earnings calls in this quarter versus only 36 a year ago. So very quickly, this has really transformed the conversation, become the biggest story within the technology space. And really, this week, we moved into that mania phase, and it really happened on the Nvidia earnings call. So what happened on that call? Well, Nvidia basically said the current quarter not doing so well, revenues down 13% year over year, but that really is the end of the old era. The new era, they're going to see a huge shift higher in terms of revenues. They're expecting 11 billion in terms of revenues in the current quarter. That would be a new record high for Nvidia in terms of revenues. I think the prior record was around $8 billion, and it would be a 64% year over year increase. And importantly, why did Nvidia's stock surge higher, hit new all-time highs? Well, this was 50% higher than what Wall Street was estimating. So Wall Street was thinking 7 billion for the current quarter, so saying that the AI boom really wasn't going to start to hit the fundamentals just yet. But actually, it's already started, and they're talking about 11 billion. So we'll see if they can hit that number, but the expectation seems to be very high that they will, and not just hit that number, but continue to grow from there. So in terms of the stock price, again, we saw Nvidia hit a new all-time high, significantly higher than its prior peak here. Market cap approaching $1 trillion. So if it crosses that $1 trillion threshold, it would join Amazon and Google and Microsoft and Apple as the only companies in the US to have that significant milestone. So in terms of revenues, so where are we now in terms of Nvidia compared to these other big four tech companies? Well, as you can see, a huge gap here. Nvidia's revenues around 26 billion, and these other big tech companies significantly higher. The expectation, of course, is that Nvidia is going to grow its revenues rapidly. So if it does 11 billion next quarter and it continues to grow from there, perhaps we're going to see 50 billion maybe in the next year or so. But that would still leave you well below the revenues of these other big tech companies, which begs the question, as we've been talking about, are expectations just too high at this point for Nvidia? That remains to be seen. It currently trades at around 37 times sales. So as we've talked about in the past, companies that have gotten around or above 30 times sales in the past, especially at this size of the company, it's $964 billion market cap, very difficult to grow into that. Of course, investors today are not focusing on that. They're just focusing on the huge demand and the huge surge in expected growth. And for now, valuations don't seem to matter at all. So if we look at semiconductors on the day that Nvidia reported, it really lifted many of these other companies as well. So it doesn't seem to be that just Nvidia is going to benefit from this. At least that's what the market's saying. Nvidia controls around 90% of the market for these AI chips currently, but I guess the expectation is that it's going to lift everyone, even if they have a small share. This is just a new revenue driver for all of these companies as well, with the exception, of course, here of Intel, which actually was down when Nvidia reported. Not sure why it would go down on that. But if we look at the dispersion between Nvidia and Intel over the last few years, just incredible in terms of the disparity here. Nvidia more than quadrupling, Intel down 50%. And if you go back to the last dot-com boom, Intel was one of the leaders back then, trading at a very high price to sales ratio, so similar to Nvidia today. And no one would have imagined that its leadership status would be challenged. And I think that's the case with Nvidia today. So we'll look back at this years from now and see if investors were too optimistic about Nvidia's prospects. For sure, you're going to see huge demand, huge growth. The question, as always, is the price that investors are paying today too much? So in terms of the growth of $100,000, I put this out there just to illustrate how much Nvidia has run up already. If you look at the past year, it's more than doubled. Last 5 years, looking at a 6x on your investment. Last 7 years, 100,000 turns into over 3 million. 10 years, 100,000 to 11 million, and last 20 years, 100,000 to over 20 million. So clearly, Nvidia, one of the leading companies, best company in terms of last 10 years performance, but just phenomenal growth for investors. Now, Nvidia was a relatively small company 10 years ago, and today it's not so much. So going to be obviously much more difficult for it to grow anywhere near these types of growth rates going forward. But interesting this year, as we've been talking about, this disparity between tech and AI related tech and everything else is just really enormous and really has grown with this week's gains in terms of Nvidia and everything else related to AI moving significantly higher. We have the AI ETF up over 30% on the year, and S&P's up around 10%. Small caps are pretty much flat on the year, and of course, regional banks down over 30%. So clearly, the broad market and certainly tech is not concerned whatsoever with the banking crisis, or at least the short-lived banking crisis that we had with those three banks failing, the second, third, and fourth largest banks in history. And we're just seeing this huge disparity. And the question, I guess, for market participants is this going to be closed with the rest of the market moving higher, or is it going to be closed with AI coming back to reality? No idea which direction that turns. If you're bearish, you would say the participation, lack of participation of small caps and other sectors is an indication that leadership is narrowing, and that's a leading indicator of the market's going down. But historically, if you kind of test the data, there's no really rhyme or reason to this. You can see this narrow leadership continue for years on end. We saw this in the late 1990s, where for years the leadership was narrowing, and the market continued to go up in spite of that. Eventually, of course, it did break. So not a good thing. You'd rather see everything, of course, participating, but it's hard to say that is the sign the market will top today. And what a rally it's been so far in the tech space. Looking at the year-to-date returns now, Nvidia 158%, Facebook more than doubling, AMD participating as well, Tesla 50%. So all big tech outperforming the market. NASDAQ 100 outperforming S&P, outperforming Dow, equal weight S&P down on the year, pretty incredible. And we've talked about regional banks. And very interesting here, if we look at the percent below all-time highs, we actually have Microsoft and Apple getting closer every day to their previous all-time highs. Nvidia, first major big tech company to exceed that prior high. And we have the S&P at about 11% below, and bonds still 14% below their prior high. So a lot of things, if we look at small caps, 27% below their high, a lot of things still have a ways to go in terms of getting there. But the biggest companies in the world, Apple and Microsoft, are almost there. So this AI boom, this AI media has really lifted big tech, given it a second life so far this year. So if we look at the last 10 years, and I put out this not as an indication for sure that this is going to happen in the next 10 years, but the last 10 years have been so incredibly phenomenal for the big tech names. It's pretty unbelievable, pretty remarkable what they've done. And Nvidia over 11,000% return in the last 10 years at the top of this list, trailing only really Bitcoin in that category. Obviously, Bitcoin was very small 10 years ago, and now it's much bigger. But just incredible gains across the board in terms of the last 10 years for tech. And we had thought that perhaps this cycle had peaked. If we looked at the relationship of tech versus the market, you had that huge boom higher in 2020 and 2021, which was really capping off over a decade of outperformance. And then last year we saw the ratio move lower. And now this year we're seeing it just really surge higher again. So not back to that prior high, but it begs the question, was that really the top in terms of the cyclical peak for tech, or was that just a pretty sizable correction and we're going to see another move higher? And we'll have to wait and see for that. But I put out this tweet illustrating really the disparity in terms of sector returns this year, with tech up almost 30%. And you have energy, which was the leading sector last year, was up 65% in 2022. It's actually the worst performing sector this year, down 9%. And you have a number of sectors that are down. If you look at the classic defensive sectors, consumer staples, healthcare, utilities, all down year to date. You have real estate, of course, down as well, as interest rates continue to be a problem there. Housing market still in a recession. You have financials. We've talked, of course, about the banking crisis, down this year. And so a lot of sectors not really participating, but the ones that are big enough that it's lifted the broad market, lifted the S&P. So the tech, communication services, and consumer discretionary all higher significantly this year. So this is a chart showing you tech versus energy historically. As you can see in this, these ETFs only started in the late 1990s, so you don't have the huge run-up that you would have seen here going up to the peak in March 2000. But that was the March 2000 peak where the tech bubble peaked. And then you had just years and years of underperformance of tech versus energy, and it bottomed here around during the financial crisis, and slowly, and it was very slowly coming out of that, you started to see tech outperform again. And it's really only in the last 7 years we've seen this incredible surge higher, and that during 2020 and early 2021, that really surged to another level. And so the question that we asked during this period of time last year was, okay, are we seeing something similar to 2000, where this is coming back to reality? And that seemed like it was happening, but now we're seeing a reversion again where tech is outperforming. So we'll keep an eye on this chart, but very interesting. I think it would surprise a lot of people to say, to look at the last 20 years and to say that tech and energy have been pretty much even during the last 20 years in terms of performance. I think most people, if you polled them, would think that tech had an enormous lead. And a big part of that was the price that were paying back here in around 2000 and early 2000s was so high for tech that it made it very difficult for investors at the time to grow into that multiple. And so are we going to figure out a similar lesson here today in terms of valuation? We're not, where we were at, let's say, at the peak in 2021 in terms of valuations. We're off of those levels for sure. But are investors once again becoming too optimistic in terms of big tech? So let's shift gears here, talk about buying versus renting. It was a really good illustration here out of Redfin, comparing different markets in the US in terms of, is it cheaper to buy versus to rent? And in their assumptions, they're assuming a 5% down payment to buy, 0.5% on homeowners insurance, a little bit over 1% for property taxes. Interestingly, they don't include any assumption for repairs or maintenance. So it's really not one apples to apples comparison, but still very interesting. Their analysis found that in almost every major metropolitan area today, with the exception of these four areas here, Detroit, Philadelphia, Cleveland, and Houston, with the exception of those four, everywhere else in the country, it's currently cheaper to rent versus to buy. And we've talked about the reasons for that, just the huge appreciation in home prices over the past few years, over 40% in a 2-year period, and doubling over the last decade. And rents, although they are much higher, they haven't gone up nearly as much. And then we also have, of course, that huge factor of mortgage rates going from 3% to more than 6%. And now in the latest data, we're seeing mortgage rates again over 7% in many areas. So if we look at where housing is the least affordable, probably not surprising, especially if you live there. California, always at the top of the list in terms of a lack of affordability. People are leaving California, but apparently not fast enough to really reconcile this. Home prices there are still extremely high compared to what you can rent that same home for. So we're looking at areas in San Francisco where it's more than double in terms of comparing the price it would cost you to buy a home versus rent a home. So very interesting looking at this data. I think they said the national average is around 25% in terms of it's 25% more expensive to buy than to rent. And this is going to be highly influenced by the direction of mortgage rates. So if mortgage rates were to come down, let's say to 5%, this is going to be this ratio is going to close. If it goes to back to 4%, it'll close even more. And of course, if rents were to come down in price, that would change things. And so a lot of factors going into this. But for now, and this is something that historically has been a pretty good indicator looking at buying versus renting to say, is the housing market overvalued or undervalued? And here you would have to say, based on the data in many areas, it's very much overvalued at the current level of interest rates. So, speaking of that, we got data from Redfin for April, looking at the year-over-year change in the median U.S. home prices, this actual sales price data. And what they found is a 4% decline year over year. That was the biggest year-over-year decline we've seen since 2012. So over a decade, 11 years, you have to go back to see a decline this big on a year-over-year basis. Now, 4%, not huge given the run-up. Remember, prices were up 40%, over 40% in 2 years. But it's something. It's better, obviously, if you're looking to buy a home, it's better than nothing. And if we look at new home prices, we have data that just came out. And good news there is new home prices, the median sales price was actually down now 15% off of its peak from last year. And if we look at the last housing bubble, we actually saw over 20% decline in new home prices. So perhaps there's more to go, but if you're in the market looking to buy a new home, cheaper today than it was last year. The problem is that mortgage rates are much higher than last year, so it doesn't necessarily mean that it's more affordable. It's certainly not, as long as mortgage rates are where they are. And to just give an illustration of today versus a few years ago, this is the comparison I always like to make. And we're looking at a over 100% increase in what you need for the monthly payment now versus 3 years ago. So just an enormous difference. And now you have to put down 26,000 more, assuming you put 20% down, which apparently very few people do. Looking at a lot of the data, most homes now are being purchased with less than 10% down. So very few people putting down that 20% payment. But if you were to put that down, you would need to save $26,000 more for a new home today versus three years ago because of that increase in the home price. So if the market forces go to work here, with the exception of the inventory problem, you would say prices would either have to stay flat or go down, stay flat and let incomes catch up, or go down to become more affordable. We'll see what happens. The main factor is still very much a lack of inventory. If you look at new home listings, they just collapsed over the last year, and they're at their lowest levels in a while. I'll talk about that next week, focus on that in the video for next week, how that's really driving things. But in terms of Fed policy, the June hike, which was really not priced in at all a few weeks ago, looking at a 0% hike, just a few odds of a hike just a few weeks ago. And now we're up to 65% probability. This is a little bit surprising to me, given all of the inflation data that we've seen showing a trend moving in the right direction, and really how Powell talked about in the last meeting, kind of hedging his bet either way, saying, we could pause here, we could do another hike. So this is surprising to me. I think this is going to shift back and forth, obviously, in the next few weeks. And remember, they're going to get that CPI report a day before the FOMC meeting, and that report is likely to show a huge decline because we're seeing just commodity prices way lower than they were a year ago. So I expect to see low 4% CPI when we get that report just before the Fed meeting. Will that be enough for the Fed to say that they want to pause? I'm not sure, but as we talked about, the evidence continues to build in terms of they could actually wait a month here. And if they wait to the June CPI report, you're going to see a 3% number most likely if nothing changes. So good news on the inflation front. We'll see if the Fed wants to do one more. We'll talk about the PCE in a little bit in terms of if they're going to focus on that. Maybe that would argue for a new hike. But in terms of what this is doing, the Fed hikes to deposits, you're seeing just a continued outflow in terms of bank deposits. This is now the biggest drawdown in terms of U.S. bank deposits since 1975, 5.5% off of their peak from last year. So huge outflow out of banks. Where's that money going? We've talked about it. Money market funds, you could just get over 5% now on most money market funds. Treasury yields are going higher, and the average savings account rate at a bank in the US is still only 25 basis points. So not really comparable to what you can get with minimal effort. So a lot of people are voting with their feet and saying, I'm not going to accept zero anymore, especially if the Fed is going to hike rates again, and they're not going to cut them. Let's say next month, they're going to leave them at 5% for a period of time. Well, then really I should go out and get a better rate. And while online banks are really increasing their deposit rates, and you can get over 5% in a number of online banks, the traditional banks and big banks like JP Morgan Chase and Bank of America, Citigroup, all of them are still offering close to zero on most of their savings account products. So 3-month treasury bill yield up to 5.4%, right? That's driving on the expectation that the Fed could hike rates again to 5.25 to 5.5%. And that's the highest we've seen since January 2001. So over 20 years, you have to go back to buy a 3-month treasury bill for 5.4%. And importantly, this is now above the rate of inflation. So you're finally earning a positive real yield on your money. So if inflation now is going to be, and I think the next number will likely be low 4%, you're going to earn over a point higher in terms of just safe short-term treasury bills versus that inflation rate. So very good news for savers. You don't have to take any additional risk to get a higher return. You just have to go out and either buy treasury bills or find a bank with a higher yield. And assuming you're under that FDIC limit, you can get a higher yield with no additional risk. So I want to talk about this sneaker slowdown. And the sneaker market's pretty interesting. If you look historically around recessions and early stage expansions, what you see is interesting consumer behavior around sneakers. Very early on in expansions, especially where there's stimulus involved, this tends to be a place where consumers go first. For whatever reason, they go out and purchase sneakers when they're feeling better about the economy and when they have more money in their pockets. And so this data from Foot Locker would be an indication perhaps that we're seeing the opposite here. We're seeing 11% decline in Foot Locker's year-over-year revenue growth. As you can see, revenues exploded higher with the 3 rounds of stimulus. Of course, there was a big contraction before that, but here we're just seeing growth slowing. And what they talked about in their earnings call was lower tax refunds, and really the issue that we've been talking about for the past 2 years, which is consumers are under pressure because you have this persistent inflation in necessities and household goods, gas, rent, groceries, and that's crowding out now discretionary spending. And perhaps if you don't need a new sneaker, but you wanted one, and for style reason or fashion, you'll put that purchase off. And what they noticed importantly here too, as we talked about last week, is an increasing usage of credit. So credit is really providing that ability, is increasing the ability of the consumer to spend money that they don't have on these discretionary type goods. But as we talked about, there's going to be a point where the consumer says, I just can't do it anymore, or I shouldn't do it, or the banks are going to say we're not going to extend that credit because we're worried about the economy, or we're worried about the consumer pulling back, or we're just frankly losing deposits, so we can't make as many loans. And that chart we showed last week in terms of tightening lending standards, I don't think we've seen the full impact of that just yet. So in terms of that, similar theme is there should be, if the market is correct, a wave of defaults in the commercial real estate loan space to come. And why do I say that? Because if you look at the CMBS spreads, so these are spreads above safe securities on commercial mortgage-backed securities, we're now at the highest levels since March 2020, over 1,000 basis points. So you have to assume here that the market is somewhat rational here in saying there's going to be higher default rates, and that's why they're compensating investors who are buying these securities for that additional risk. So could the market be wrong? Yes. Is it likely to be wrong to the extent that there's no increase in delinquencies or defaults? Probably not. And where we're coming from is near record lows in terms of delinquency. So delinquency rate hit a record low just last year, and we're just starting to move higher here. So really, we're at the early stages, I think, of what this is going to become an increasing problem. Does it have to be as big of a problem as it was in 2008? No, but certainly all indications seem to be that you're going to see more commercial real estate stress in the coming months. And this could be a cycle that takes years to really clean out. And so we've talked about commercial real estate prices coming down for the first time in over a decade. Talk about the exposure of regional banks. It's really one of their biggest loans in terms of their balance sheet is in the commercial real estate space. So again, this is just starting to become a real issue and a real problem. And I think we're going to hear a lot more about it in the months and years to come. So let's very briefly touch on the debt ceiling, and who knows, by the time I put out this video, perhaps there will already have been an agreement. But in any case, they've waited pretty close to the end here in terms of running out of money to come up with a deal. And really, the headlines, you could just ignore them all. Every headline is talking about a depression or a huge decline in economic growth. I think I saw one headline saying there's going to be a $12 trillion hit to U.S. GDP. This is another headline here saying 8 million jobs are going to be lost because of this debt default. And yeah, I guess theoretically, if the U.S. government just said, we're not going to pay back any of the interest or principal on the bonds that we've issued, the over $31 trillion in debt, we're just going to stop paying interest or principal on that. Yeah, perhaps that would lead to a complete collapse in what everyone is predicting. But that's not going to happen. The U.S. government is going to make their interest payment. They're going to do what they've always did, which is raise the debt ceiling. And in the short run, this is causing kind of a crazy thing going on in the markets where this 1 month treasury bill yield is exploding higher up to 5.95% because the thinking is, well, if the U.S. government's going to default in the next few weeks, then these short-term securities are going to be the most at risk. And therefore, I should sell those and buy longer-term treasury bonds if I have the option to pick between the two. So selling these causes the interest rate to rise. And what you're seeing now is a very weird thing where the 1 month treasury bill is 57 basis points higher than the 3 month. You don't typically see that huge of a disparity. And that's all because of this potential default. But I think this is absolute nonsense. As soon as they come up with a deal, you're going to see this relationship go back to normal here, where there's a very little difference in the spread. So if we look at the history of debt ceilings, got to go all the way back to World War I. It goes back to 1917 when it started. And the history of it is that the debt ceiling's always been raised in the past, and that makes sense why it's raised. This is money that Congress already agreed to spending, and then so you can't come up later and say, well, we have this limit after we've already agreed to spend all of this money. That just doesn't work. So I don't know when it'll actually occur. Maybe they'll wait till a day before or 2 days before, but they're going to come to some type of agreement, raise that debt ceiling, and then a year from now or 2 years from now, whenever that next ceiling is hit, we'll have the same debate. Now, should they even have a debt ceiling? Probably not. They should focus on actually trying to keep the debt from increasing at the pace that it's going up. So more important is to not spend more money than what's coming in, than to have this fictional debt ceiling, because you cannot have a debt ceiling when the national debt only goes in one direction, and that's up. So we have these national debt milestones being hit every single year. And in 2020, we hit a whole bunch of them. 2021, 2022, a few more. So we started 2020 with 23 trillion in debt. Now we're up to 31.4 trillion. And when they raise the debt ceiling, you're going to see that $31.4 trillion immediately bump up a few hundred billion. We could very easily see 32 trillion, before the end of the summer. Certainly this year, we're going to see 32 trillion in debt. So the debt ceiling will be raised, but really they're missing the forest for the trees here and having this debate about a ceiling. What they need to do is come up with a long-term solution to reduce the deficit. So deficit's still running at $2 trillion. And as long as that's the case, can't have a ceiling on the national debt. It's going to have to be lifted. So this will be, I think, a bigger discussion in 2024 with the election. How much of a deficit should we be running? Should the deficit to GDP continue to go up? And what are the long-term consequences of that? And should we really wait until it becomes a crisis before we start to do something about it? So all of that will have to be worked out. But for now, we're just doing these nonsense shenanigans, arguing about a debt ceiling that doesn't really it exists on paper, but it isn't feasible to have when you're borrowing $2 trillion in excess. You need to borrow $2 trillion because you're spending $2 trillion more than's coming in, so you can't have a ceiling. So let's shift to two more things that are positive here, and we'll end with that. One is the travel market, which is absolutely booming. We've seen a complete comeback now in terms of the airline travelers in the US, 2.49 trillion over the last week. That's the highest we've seen since August of 2019. So if we compare current levels to 2019 levels at the same time, the last week in May here, what we're seeing is numbers are actually above those 2019 levels. So a complete recovery now for the airline travel industry. Pretty remarkable. A lot of people did not predict this a few years ago. They thought this was going to take really much longer for the recovery to happen, but there's a lot of pent up demand now in terms of travel, and you're just seeing that every single day with consumers maybe pulling back in terms of their retail spending, but they're not pulling back at all in terms of their travel spending. And interesting chart here that I put out. They have data on domestic airfares going back to 1995, and a very different picture if you look at nominal prices, so the actual airfare prices that you pay in dollars versus inflation adjusted prices. So the light blue here is the nominal prices, and you can see big surge higher. We hit a record high recently in terms of nominal prices coming out of the COVID pandemic. And if we look at real inflation adjusted prices, much different story. So prices since 1995 have actually declined 33% on an inflation adjusted basis, while nominal prices have increased 33%. So if you're wondering why there's still a lot of demand for travel, even though prices are up significantly over the last year and over the last 2 years, well, airline prices compared to, let's say, 20 years ago are actually much cheaper on an inflation adjusted basis. So if you're looking at people's wages, the increase in people's wages have exceeded the increase in airfare prices. So for most people, it's more affordable to travel today than it was back in the 1990s. That's a good thing. You want to see that. This is what you would like to see for all goods to see and services for this to be the case. But I think this just gives a little bit perspective that even though airfare prices seem crazy and they are much higher over the last year and the last 2 years, on an inflation adjusted basis, we're nowhere near where we were 20 years ago. So a good thing. Hopefully this will stabilize and come back down. Competition will bring it down. But for now, there's just so much demand. Airlines do not have to cut their prices. They've been keeping their prices elevated, and until the demand supply situation changes, that'll continue to be the case. Now, this one's even much more of a surprise to me, and certainly to market participants, I think, as well. We're talking about all of the cruise lines going bankrupt in 2020, and for good reason. Really, there was no one taking any cruises back then. Even a year ago, if we look at occupancy rates for Royal Caribbean, 57% in early 2022. Now we're at over 100% occupancy, which probably saying, well, how's that even possible? And so I looked it up, and I guess if it's over 100%, it means they're booking more than 2 people per room. And so I guess they have some leeway in terms of how much, how many people they could put on these enormous cruise ships. But certainly, if you're taking a cruise today versus a year ago, you're going to notice a much, a much more crowded ship today. So perhaps won't be as enjoyable for people, but for the cruise lines, very good thing in terms of the demand seems like it's back. And this again comes back to the pent up demand. The people who like to take cruises couldn't or wouldn't and take them and for a few years, and now they feel like they're able to again, and they're finally doing that. And speaking of that, another surprising one, I think for a lot of people, looking at conference demand, so industry conferences really froze to a halt. This left side here is the conference attendance before COVID, and then during the closures, and really throughout 2020, almost no conferences were held in Las Vegas, slowly coming back. And now finally in March of this year, we hit a new high in terms of conference attendance. And if we look at these hotels index here, we're above 2019 levels as well. So incredible comeback for the travel industry, and hopefully that stays the case and that continues. So if we look at the road back to normal, ending with something really positive here, and some might debate that this is not positive because it's caused some problems for the markets and may cause more problems to come, but I continue to argue this is the most important chart for the long-term health of the U.S. economy and for the prosperity of the U.S. as a nation. And that would be the thing that the Federal Reserve never talks about, the money supply. And the money supply is moving very much in the opposite direction than where it was moving during 2020 and 2021. So now we have a 4.6% decline in the U.S. money supply over the last year, with data going back to 1960. That's the largest decline on record on a year-over-year basis. And no, this doesn't erase what we saw during 2020 and 2021, which was over 40% increase, but it's a move in the right direction, as we talked about. So as long as this continues, I have a positive outlook for inflation. This is a leading indicator, of course, for inflation on the way up. On the way down here, I continue to say this is going to lead to lower inflation rates to come if we can continue to shrink that money supply. And again, I think we're likely to see a 3 handle on the U.S. inflation rate on CPI when we get that June CPI report. So good news, hopefully continues. In terms of the Fed balance sheet, as I said a number of times in the last month, you want to watch this because you want to see this balance sheet moving down again. And we had this brief period of financial stress where the Fed injected huge amount of liquidity into the system via loans to many different banks, $392 billion. That was not a good thing for the markets if it were to continue. Certainly, it may have helped stabilize things, but now we're seeing this trend reverse, and more than 75% of that post Silicon Valley Bank spike in the Fed's balance sheet has been reversed. And so you want to see this continue. The Fed wants to continue to normalize the balance sheet, and this, similar to the money supply, you want to see this continue to come down to really normalize and try to get back to a more normal level. Now, will they get there? I don't know, but in the short run, you want to actually see this continue to come down rather than the Fed feeling like they can't continue to let the securities run off and they have to come in and start buying again. So in terms of inflation, Truflation puts out this real-time inflation gauge. Has got a number of different inputs that they look at. They're also putting in, government data points as well when they come in, things like CPI and PPI and CPA and all things like that. But they're now saying that the inflation rate in the U.S. year over year is under 3%. So pretty remarkable here. What a difference from a year ago. And we saw in June this hit 12%. And now we're under 3%, moving in the right direction. I think this is a good forecast of where we're going to see CPI in 2 months. Hopefully we'll get down this low. Might not quite get there, but the year-over-year comps in terms of commodities are looking very, very good. And I suspect food price inflation, when we get that May report in a few weeks is going to show a significant decline there as well. And heading into Memorial Day weekend, gas prices last year was really all anyone could talk about. They were heading towards $5 a gallon nationally last year, which was a record high. This year, much better picture in terms of retail gas prices. We're down 23%, over $1 a gallon from where we were a year ago. Just a much better outlook. AAA had a stat saying that they think that travel is going to be up 6% this Memorial Day weekend versus last year. That's their expectation. So it's not due to a lack of demand. Demand is actually increasing. That we've seen this price decline. Had supply meet demand. This is a good thing, a normalization. And so again, and I'll show this in the next video, similar to the concept around airline prices. If we adjust this for inflation, retail gas prices are much lower than they were in 2008. So this is at $3.60 a gallon, not going to curb driving demand. Again, we're expecting to see a 6% increase here. So very good thing for the U.S. consumer heading into Memorial Day weekend. And with that, good news. We'll end the video there. Thanks everyone for joining me. Have a great Memorial Day weekend, everyone. If you like the content, as always, subscribe to the channel, and I'll see you next time. Thanks.